Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so looking at our market today, we have closed right on our lows and now testing that short-term uptrend line that we've seen come through since early December. This is really quite a critical level. We've got a couple of moving averages here. 74's also been a bit of a level of support and resistance in the past. So at this point, we're just waiting to see whether we're going to break lower. And if we do, the next target's obviously 7,300, where the 200-day moving average sits. Then from there, we'll come back and look at the bottom of this channel. So really, if we take a broad look at this market at the moment, we've had an uptrend since really the lows of COVID there. That uptrend really ended through here, and now we're in a sideways phase. So really what we're looking for to call this a trending market again is a breakthrough into the all-time high. That's the continuation pattern I'm looking for the overall market. So for now, look, I think we're going to stay fairly volatile but sideways for a little bit longer. And then once we start to see the COVID cases spike and we start getting closer into the reporting season, we may then see that sort of push up that we're looking for. So coming across to the US markets, the S&P 500 in particular came down and tested the long-term trend last night. Nice reversal there. What we want to see out of the US tonight is a bullish signal through the 4,700 level. If we see that, then we're probably going to head back up to test the all-time high at 4,800. If they fail from that, well, if we fail to break through 47 really, then I'm going to start questioning whether we're going to hold 46, right? So, the US is in danger of going for a correction. Okay, so for the S&P 500, really that's quite a distance away, right? They're not even close to seeing correction levels. The Nasdaq, on the other hand, is a different matter, and that is where most of the selling is happening, right? So this is the chart for me also to watch right now. So the Nasdaq from the all-time high created in December down to where they finished last night was just shy of 10%. Okay, so that's just shy of correction level. So I'm not surprised to see some buying come back in. Once again, we want to see a bullish signal to confirm this reversal. Okay, there's plenty of technical levels to buy from here. We're seeing a bit of buy the dip overnight, but let's just see whether that buy the dip mentality can continue after that negative news we got from the Fed minutes a couple of weeks ago. And that's what's really triggered all this, guys, okay, is those Fed minutes. That was the starting point to a lot of the selling we're seeing currently. Yeah, so really the big news right now is interest rates and the Fed. Okay, so in the Fed minutes last week, we saw a bit of a change to hawkish, haven't we, right? So interest rates are likely to go up, is what they're saying. Most of the big investment banks in the US are all coming out expecting at least 4 rate hikes this year. And that wasn't, to me, much of a shock because that was sort of the rhetoric last year as well. What really got me was the talk about running off their balance sheet, which means the securities that they bought off market doing QE, whether it be mortgage backed or straight out bonds, they're going to sell that back to market, right? Maybe, right? There's a big maybe there. So if they do that, though, without the right economic strength behind it, the markets won't like it at all. And even with the rate hikes, I think the market can handle 1 or 2 rate hikes. But if they start talking too hawkish at the wrong time, then we could see a pretty decent crash off, right? So timing's key. Okay, with any sort of movement from central banks and how the market reacts, it's not about what the central banks do, it's more about the timing on when they do it. Now, what we've got to ask ourselves here is why are they increasing interest rates? Well, if it's to battle inflation and you believe the inflation's transitory and it's being caused by coronavirus and supply chain problems and staffing problems and that sort of thing, well, that can be corrected as the virus comes under control and vaccination comes in, right? Which means we might just need to wait another 12 months to fix that problem. If the Fed's increasing rates to try and battle that inflation problem, and it is just a transitory issue, then when we come into next year, we might get walloped. The economy might get walloped, right? So if the Fed moves too quickly and at the wrong time, that's very negative for equities. Okay, very negative for equities, in particular growth stocks. Okay, so rising interest rates in this environment, growth stocks are less favorable. Okay, people move more towards value investing, so they'll be looking for stocks that actually make a profit every year, give a decent dividend, and are more safe companies to invest in. We know sort of more those blue chip type of stocks that have been around, they're proven, good management teams. We're getting back to typical fundamentals, where the market for many, many years has been going more towards the speculative growth stocks, where it doesn't matter if the company's making money or not, they're in growth phase. We just want to see huge revenue increases every single year. So what we're seeing right now, and we saw this a few times last year, this theme come in every time we start getting really serious about interest rates, is that the NASDAQ gets hammered because that's full of those type of tech discretionary high growth stocks. And we start to see the S&P 500 and the Dow Jones perform a bit better. Now, our market comes into that category of performing better. We are a value market. Most of our top 200 stocks would be more considered as a value stock than a growth stock. So, we are seeing the things like BHP and Rio and Fortescue rise, okay? And they pay good dividends as well. Like you could almost say they're a growth stock, but they give such a good dividend. They're really a value stock, and they run at such low PEs that they're a good value stock. So we're seeing the miners outperform for a few reasons. One, their value, but also there's a strong sentiment out there right now that commodities are going to perform well for many years to come. Between green energy, between infrastructure spending, all that sort of stuff, we expect that demand for industrial metals to continue. Banks should do well with interest rates going up. Okay, so there's certain sectors and certain stocks you want to be in. Now we've got to be a lot more selective. All right, so 2022 is more of a year of being selective. It's not about always being in the market. It's about what stocks do I want to be in and when, because we're going to see volatility this year, I believe. I think we'll see quite a few corrections on this market. And I'm not just talking about the 10% we saw on the NASDAQ. I mean some proper corrections that we used to see. The safety net's been ripped out. Okay, the safety net has been COVID spending. It's been a lot of stimulus. It's been the central banks, QE, near zero interest rates. All of that's coming to an end. Okay, once again, it comes to timing. So, what do I mean by timing? Well, it's the wrong time to be talking about it right now when worldwide cases are leaping every single week. So we went from 6 million cases to 10 million cases to about 16 million cases worldwide this week. Well, I should say last week's data. Okay. So every week that goes by, we're seeing this massive leap in cases worldwide. The silver lining of Omicron, though, is that it actually has much lower hospitalization and much lower visits to the ICU. Okay, so less ventilators needed. We're seeing that through Australia at the moment with these spikes of cases. Is the hospitalizations, although it's not ideal, aren't getting not getting overrun. Right, there's still enough beds out there for people. Where the issue is right now with the current strain and what's happening around the world is actually more to do with staffing and supply chain problems. So a lot of restaurants are having to close their doors because all their staff have COVID. 40% of the factory workers of Woolworths have got COVID, so they're struggling to get the stock to shelves quick enough. There's issues like that that are coming forward that could continue to cause that inflation to go up. Okay, so it could be disastrous if the Fed increased rates too rapidly, too quickly on the back of this. Okay, so this year's that balancing act. If the Fed gets it right, then the markets will stay calm and they'll move up accordingly. Okay, if the Fed gets it wrong, then the market will send the message. Okay, so that's the big thing, guys. It's going to be a massive balancing act between COVID and when the Fed decides to increase interest rates, and if they decide to start running off their balance sheet. My view on all this, guys, will be I think the Fed might increase the rates a couple of times, 2-3 times, and then back right off. All right, so the Fed might send a message to everyone saying, hey, chill out a little bit. If you let things run too hot, we are going to rapidly do something. But if the Fed moves slowly, okay, justifies their moves, okay, and is backed up by strong economic data, the market should be okay with it, okay. If you actually look back in history, often when interest rates go up, the markets continue to rise strongly because there's usually really strong economic data and a really strong outlook that goes with that. This time around, the outlook's a bit hazy because of COVID. Okay, the only reason why we're here really is because of the COVID spending and the stimulus. That performance we saw in the US markets was all stimulus based for the last 2.5 years. Okay, so that's what we've got to look at is now that unwinding this stimulus, we need the economic data to show that the economies of the world are going to stand up to COVID on their own 2 feet without this stimulus in the background and continue to grow. Okay. Now, at this point of time, really, we're waiting for the US reporting season to kick off. We got an inflation reading later this week. There are just a few little bits of information that could kick this market around. I suspect we'll whip around quite a bit over the next couple of weeks until we hit that reporting season. If it's a good reporting season, I think we'll see another climb in the market into February, as we commonly do. Then in early Feb, our reporting kicks off. Once again, if it's a strong reporting season, it's an excuse for the market to go up. So your seasonal pattern usually is a climb into February, a slight pullback late Feb into March, sideways into May, and then things start moving again. Okay, so that's your typical seasonal pattern. We'll be looking for signs on whether that plays out or not this year once again. So thanks for listening in. First video back for the year. So welcome to 2022. Happy New Year. I hope you all had a good break, and I'll catch you all next week. Thanks and bye for now.